Hello, everyone, and welcome to another episode of the MRMIA broadcast. Today, we have a special episode with Raymond Anderson, the author of Credit Scoring Toolkit and Credit Intelligence and Monitoring. And today, on this Small Risk Managers International Association broadcast, he's actually going to be talking to us about the aftermath of the pandemic, right? How to fix our broken models. I'm your host, Marc Leprince. And Raymond, would you like to introduce yourself?
Hi, Mark. Thanks for having me. A correction. So the second book is Credit Intelligence and Modeling, not
Modeling.
monitoring. It's currently in production with Oxford University Press. I'm hoping that it'll be out in about the next 6 months or so. It was 5 years in the works. And it's going to be sort of something to have it actually sort of on the bookshelves when it finally does come out. In terms of introducing myself beyond that, I'm originally Canadian. I am doing this from Johannesburg, South Africa, where I've lived for the past 40 years. I was doing something earlier trying to say, okay, a lot of Americans might say, I know somebody in Nigeria. And I went on and I looked, how far is it from Johannesburg to Lagos? And it's 92 hours by road. And if you took that the distance, and it would take you from Prudhoe Bay in Alaska down to Mexico City. So don't underestimate the distances here. They can be quite large. And I don't know very many in Nairobi. I don't know very many people in Accra. So, Southern Africa, you might stand a chance, and I might know somebody kind of these parts. Anyways, I spent 34 years with the Standard Bank of South Africa. I left them in 2015, and since then have been doing short-term work with the International Finance Corporation and various capacities. And over the past 2 years, I've taken an interest in model risk management. You said MRMIA. It's amazing how everybody nowadays, they try to turn acronyms, series of letters into a word.
That's right.
Vacation rentals by owner became verbal. The Italian crowd, CRIF, are now calling themselves CRIP. So wherever you used to sort of use an acronym, it's disappearing. It's turning into a noun or a verb.
Oh yeah, oh yeah. Across the board, across the board. So we have another fun name to put your way, and that's the COVID-19 pandemic. And
yeah, that thing. I've heard of it.
Yeah,
I've heard of it.
It's been on the news recently and quite a bit lately. And after it hit, not only did it kind of blindside society, but it also blindsided a lot of financial models. And even though we're in the midst of everything, I wanted to get your kind of initial thoughts on what model developers should be doing to kind of adjust their models or fix their models now that the pandemic has hit.
All right, the first thing that I want a model to know when the bottle stores are going to open, when the liquor stores, as you might call them, because we're currently a dry country. And my wife, she's been buying stuff on the sly, and she's down to her last bottle. When she doesn't have her 2 glasses of wine a night, she becomes very cranky.
Affecting the stability. It's affecting.
Yeah, that domestic stability becomes a bit of an issue when she doesn't have her 2 glasses of wine. But in any event, so now that it's happened, for model developers, it's not something that a model developer can, or validator or whomever can do by themselves. it's a group task where you have to sort of
Mm-hmm.
work with other people. You might have, at least for the moment, there's a lot of stuff that needs to be done judgmentally.
Mm-hmm.
You're going to have sort of expert judgment coming into play, or has come into play.
Mm-hmm.
Expert overlays, a lot of drill down, varying cutoffs. The just trying to navigate the seas by the seat of your pants.
Right.
And at some point, though, okay, there is some stuff that one has been able to do, looking at sort of recalibration and perhaps augmentation. It's like looking at the historical distributions and re-rating them, having sort of time varying models to say, okay, are we moving out of this? When I say time
Mm-hmm.
varying models, it's developing models in sequence and see how the predictor is changing, and trying to extrapolate that going forward. But all of that is more on the analytical side. The recalibration, not.
Right.
That's one might be able to get practical stuff out of that. The redevelopment is bringing in other data sources
Mm-hmm.
and perhaps looking at aggregations that what the machine learners might call sort of the other features that previously hadn't been considered based upon the existing data.
Mm-hmm.
So and beyond that, sort of one's looking to, and here again, it's not the modeler
Right.
necessarily, unless the modeler has access to things that were not in the existing pot prior to the pandemic. The proxy data,
Mm-hmm.
using information from other geographies, other industries, perhaps. Mostly it's going to be geographies.
Right.
Italy went through it first. What did we
Mm-hmm.
learn from Italy? China went through it first, but they did things totally different from everybody, especially the Americans. And so one can bring in proxies from elsewhere, or looking to alternative data. The alternative data, the one thing a lot of people had ignored was transactional data. Some banks were using it quite effectively when they had their own internal transaction data, but elsewhere it wasn't used, especially in emerging markets. And that's really coming to the fore in Europe with the Open Data Initiative, where all of the bank's data, at least, is now practically available for everybody else to use, especially the fintechs and alternative lenders.
Mm-hmm.
But for those that didn't use it, well, dig into it sort of to the maximum extent possible, because that is going to be a very quick and reactive indicator to show where things are happening. It also gives the ability to drill down into various segments within the business, whether you're talking about personal market or
Mm-hmm.
small business market or wherever. There'd still be a lot if you're getting into the capital adequacy stuff.
Right.
The loss severity, different story. Most of my experience is on the originations and the behavioral scoring side, all probability modeling or rank ordering type stuff. And when it gets into the loss severity, it's going to be that much a little bit more difficult, because it's going to take longer for the situation to become clear.
Mm-hmm. And this brings up another good point here, that um, this data about changes in behavior, consumer trends, even what governments are doing as a reaction to this pandemic is still evolving.
It's still evolving, but you've
Right.
got two sides to that. The evolution is the one thing,
Mm-hmm.
and whether or not what's been going on is adequately being captured is another thing. You
Yeah.
got with a lot of the forbearance where companies were saying, okay, we are going to let you off easy. But did they actually record what was done and where was that recorded? Was it in the core banking system? Was it in the collection system? Was it in sort of somewhere else, just within sort of some spreadsheet that
Right.
was trying to manage everything? So there are going to be a lot of data issues regarding the forbearance that's been allowed over the period.
Mm-hmm.
And it's well possible that the situation may only become clear once the forbearance starts, I say easing, it's not really easing, it's once things start normalizing.
Yeah. And this is.
As, especially interest rates, because
Mhm.
the interest rate situation, it's been abnormally low. So what happens
Right.
when things start going back up again? I mean, the stock markets are kind of going crazy because there's sort of so much liquidity in the system, and the people don't have any place to put their money to try to earn. The stock market tanked, and it's right back up, perhaps higher than where it was uh,
Right.
before the crisis.
Mm-hmm. So and that's kind of going down the road I wanted to address is that um, you have a bunch of varying data points, and because we're kind of in the middle of this, we don't really know where that data lies, where it should be located. Um, and there's still a lot of trends that are taking its course right now. So my kind of question to you is that um, how should we use this data from, if we're going to call the pandemic a shock period, how should we kind of define the limits of that shock period? And um, can you give us some insight as to, at least based on what we know now, how we should use this kind of data on forbearance or something else?
That's a difficult one.
Mm-hmm.
Uh, Everybody's going to be muddling their way through. Sort of, if you're looking at the shock period itself, within the period, you might be using the data to see what happens, kind of to
Mm-hmm.
model the how it works its way through the system. One of the things that was rather surprising was how the bureau scores from FICO they went out of kilter for like 3 to 6 months, but that's because of the data definitions. Because it took a while for certain triggers to be hit,
Mm-hmm.
then it got knocked out of kilter. The ranking ability sort of reduced sort of quite significantly, but
Mm-hmm.
then within months, within the shock period, it recovered. But the default rates were higher.
Mm-hmm.
So you have a lot of workings that are going on within the system that aren't necessarily well understood. So you can get some clarity there. But as far as where I have more of an interest is where were they before the crisis and
Mm-hmm.
where will they be outside of the crisis? A lot of our stuff looks at 1 year windows or 6 month windows. Well,
Mm-hmm.
perhaps we need to be taking a look at much longer windows and saying, how did the person come out of it? What is going to be a little bit problematic because a lot of it is going to be demographics, especially relating to industries and types of employment. And unfortunately, a lot of those industries and types of employment uh, are where the more vulnerable are employed.
Right.
So you're practically going to say, okay, these guys got smacked hard. So now I'm going to use that going forward, just because I know that they will get smacked hard.
Mm-hmm.
And that's going to perpetuate a lot of biases. So, and yet at the same time, if you're talking about fair lending, do you actually want to lend to those people when you know that you're potentially indebting them,
Mm-hmm.
and they are likely to go through stresses? Something I
Right.
always like to highlight is that there are three major reasons for loan defaults in the personal market. It is job loss, ill
Mm-hmm.
health,
Mm-hmm.
and domestic upsets.
Mm-hmm.
If you have a population that is more prone to those upsets, then their credit risk is likely to be higher. But at the same time, it goes in reverse, where
Right.
if you lend money to them, you're likely to cause those issues. You might cause the job loss, you cause the domestic upset, you cause the ill health just
Mm-hmm.
from the stress that you're creating by having lent them the money. So uh, I'm very sensitive to issues on the fair lending side, and there are circular relationships where you're trying to be
Mm-hmm.
fair, but in the process of trying to be fair and providing access to the credit, you could end up being unfair by creating problems that you could not foresee.
Right. Right.
So, my wife's a psychologist, so she has to deal with a lot of the fallout from these types of things where people
Mm-hmm.
either make bad decisions or have bad decisions forced upon them.
Yeah, and it just kind of puts everyone in a a tough situation. And if I'm kind of understanding correctly, uh I mean, at least right now there is no real good way to kind of define um the ends and beginnings of this kind of shock period. And there is no.
There's no way of
Mhm.
defining the beginning or the end, although the beginning is probably easier to define, like November, December of 2019.
Mhm.
Um, but it took a while for it to really start hitting, and that tended to be more about March. The question now is going to be, when are we going to be coming out of it?
Mm.
That could be the middle of 2021. It could be the end of 2021. It could be sometime in 2022.
Right.
But my own expectation is going to be within the second half of this year,
Mhm. Okay.
where we're going to see a lot of normalization, especially if one starts getting the vaccine rollouts and people start behaving themselves.
Yeah.
The Americans have not got a very bad reputation on that side. Donald Trump,
It's in our history, Raymond. We never did well with authority.
yeah, well, it's part of your DNA.
Yeah, yeah. Um
So Agent Orange has a lot to answer for.
um so to kind of bring it to a close, what are some practical steps that modelers can take now to prepare for the eventual model recalibration or redevelopment?
Well, I'd say some practical steps. Okay, it's not again, it's not necessarily the modelers.
Mm-hmm.
Uh, the one part is going to be what trends were already in place that are going to be accelerated
Mm-hmm.
and are unlikely to be reversed totally.
Mm-hmm.
Work from home with technology is something that is likely to stay with us. People will return to offices,
Right.
but this office culture is not going to be the same as what it was before. There will be a lot more flexibility. That work from home is going to have influences in terms of the property market. It's going to have influences in terms of transportation.
Mm-hmm.
It's going to have influences in terms of communications and sort of requirements for bandwidth and telecommunications infrastructure, and the also going to be moves away from crowded city centers to
Mm-hmm.
satellite suburbs and perhaps smaller centers generally. people looking for lifestyle over convenience to the workplace.
Mm-hmm.
The beyond that, saying, get up and close to the data, trying to understand sort of just what has been happening within that data that is available. Look to the other things that you can potentially do with it. I mentioned the possibility of aggregates, of other features that one can sort of that can be brought into it, and also perhaps look at ways of combining models. We so often I came from an environment where we would just have one scorecard, sort of we put
Yeah.
one model in place, and the model was built. The first line of defense was the policy rules that were in place. But if you think of it, policy rules are a judgmental model. It's stuff that's evolved over years. So you've got you've really got two models with policy and a scoring model. So now you're trying to say we have all of this other data. How can I influence the policies to sort of be so that the policies are more robust and further, or can I have another model that can be used as a baseline that can be almost a challenger for no matter what hits.
Mm-hmm.
The other thing would be making sure that you've got a good way of comparing the results. We tend to have a significant focus on things like in my area, okay, which was on the mostly originations behavior scoring, was predictive power as measured by a binary ECGF based measure like the Gini coefficient or the ROC, ROC, KS statistic, blah, 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 blah. Are those necessarily the best ways of measuring, especially when you have differing type 1 and type 2 errors?
Mm-hmm.
I think there's a lot of questions that existed before, and they're even more relevant now when one's going through turbulent seas.
Mm-hmm. So, in kind of summary, it's make sure you understand the existing trends going on, looking
Make
at
sure you
the
understand. Make sure you understand your data.
understand your data, looking at the um, potentially using multiple options to analyze these kinds of trends. So looking at using perhaps multiple models rather than just a single model.
Yeah.
Um,
Look at your tools, look at your
mhm.
definitions. Are you using the right type of modeling approach? Uh, One of the biggest risks is the conceptual risk.
Mhm.
If you look at sort of the model risks, the conceptual input, build, implementing, and reporting, the conceptual leads off. You get the concept wrong.
Okay.
Uh, you're sunk before you start. And right now, with such shocks, those concepts are brought into question. So one should go back and revisit.
Okay. And then the last one was an effective way of comparing the results to make sure that
Yes.
it's not just predictive power, but also uh, it's robust.
So the risk, it's robust. It's you're wanting to get that interpretability. Even if you're using machine
Yes.
learning, you want to have sort of some type of a understanding as to sort of what's going on. You don't want reinforcing loops that are going through the system,
Mm-hmm.
and you want that level of fairness. Whether that
Mm-hmm.
fairness is to the fairness is to be the customer, but sort of one wants to provide access to credit or access to facilities, but not be debilitating at the same time by over indebting the customer base.
Mm-hmm. Excellent. Excellent. Well, Raymond, thank you so much I think this has been a wonderful session, and I know that I've learned a lot about what we should do to fix some of our broken models here. And as you said, this is not just a single person's problem. It's not the developer's problem. This is a team
It's
effort.
a team effort.
Yeah.
Yeah. Anyway, thanks for having me. And hopefully we can do this again under better circumstances. You might even be able to invite me
That's right.
to visit. So I might be able to invite you to visit. You can come see my garden.
That would be wonderful. I would love that, Raymond. Well,
Okay.
until next time, you take care.
Okay. Cheers, Marc.
Cheers.